Imagine placing a $10,000 bet on who will be the next U.S. president.
Right, or even something like what the inflation rate will be next quarter.
Yeah, exactly.
Yeah.
Normally, you'd be totally locked in. You would have to just agonizingly wait until November to see if you won.
Or wait until the Federal Reserve actually releases their official report.
Right. But what if you didn't have to wait? I mean, what if you could cash out your profits right now, today, at 2:00 p.m., based purely on how the public mood shifted over the last hour?
It sounds crazy, but that's where we are. The whole era of waiting for an event to actually end is officially dead.
It really is. So welcome to your custom-tailored deep dive. We take the stack of sources you provide and really extract the crucial mechanics you need to stay entirely ahead of the curve.
And today, we are looking at this single, incredibly detailed roadmap that maps out the sudden, aggressive evolution of the prediction market landscape.
Because the transformation we're seeing in these documents is just unprecedented.
Oh, absolutely. We are watching the complete vanishing of the line between decentralized finance, DeFi, traditional Wall Street finance, and everyday prediction markets.
They're all colliding into this single, highly volatile ecosystem. So our mission today is to explore how the prediction market giants, Polymarket and Kalshi, are aggressively entering this world of crypto perpetual futures.
Yeah, we're going to break down the highly complex technical mechanics of what that actually means.
And the massive turf war exploding between state and federal regulators, right?
Mm.
Plus, what this financial collision course actually means for you, the listener.
The timing on this is just perfect, by the way.
Right. I mean, today is Tuesday, April 21st, 2026.
Right.
And today is the exact day this rivalry just went into absolute overdrive.
It really did.
Okay, let's unpack this. Why the sudden shift? I mean, why aren't these platforms happy just letting people bet on elections or pop culture anymore?
Well, the shift is entirely driven by capital efficiency. To really understand why they're making this massive pivot, we have to look at the fundamental flaw of traditional prediction markets.
Which is that weight we talked about, right?
Exactly, the agonizing wait. Let's look at a standard prediction contract, or even like a traditional futures contract. Mechanically, it possesses a hard expiration date.
So you're wagering that Bitcoin hits a certain price by December, or a candidate wins in November.
Right. And when that specific date arrives, the market resolves, the contract expires, and you get cashed out.
Which totally locks up your capital in the meantime. It's like watching a mystery TV show where you and your friends have all these elaborate theories about the killer.
Yeah, but you can't actually validate your theories until the finale airs 6 weeks from now.
You're just stuck waiting. But these new perpetual futures they're launching, it's like live tweeting the show.
Oh, that's a great way to put it.
Yeah, you don't have to wait for the finale. You can just monetize your hot takes in real time and exit your position at any second.
The TV show analogy captures the user experience perfectly. But, mechanically, it goes much deeper than just letting you voice an opinion early. Well, a perpetual future is exactly what it sounds like. It's a futures contract with no expiration date. You can hold your position open forever.
Literally infinitely.
Literally infinitely. But the platform isn't just letting you hold that position for free.
Yeah.
They are actually extending you credit.
Okay, so you're trading on margin.
Exactly. You only need to keep a fraction of the trade's total value in your account to cover any potential losses.
But wait, if there is no expiration date, what keeps the price of this perpetual contract tethered to reality?
That is the million-dollar question.
Right. Because if I'm betting on the price of Bitcoin or a political event, but the bet never actually ends, shouldn't the price of my contract just drift off into the stratosphere?
It would if it weren't for a highly engineered mechanism called the funding rate.
Okay, the funding rate, what is that?
Because there's no settlement date to force the contract price to match the actual underlying asset, the market uses this dynamic peer-to-peer fees system.
A fee system.
Yeah, it's basically a tiny commission paid directly between the buyers, who we call the longs, and the sellers, who we call the shorts.
Wait, really? So the exchange platform itself isn't collecting this fee? The traders are actively paying each other.
Precisely. It's wild, right? Let's say a massive wave of optimistic traders starts buying the perpetual contract.
Which drives its price significantly higher than the actual real-world price of the asset.
Right. So to bring things back into mathematical balance, the system forces those buyers to pay a small recurring fee to the sellers.
Oh, wow. So that financially incentivizes more people to step in and sell.
Exactly, which suppresses the price back down to reality. And if the price drops too low, the mechanism just flips and sellers pay the buyers.
That is fascinating. The funding rate is like this invisible elastic band that constantly snaps the perpetual contract back to the real-world spot price.
That's exactly how it works.
That is an incredibly elegant solution to the expiration problem. But it also sounds, intensely complex.
Oh, it is. It caters to a very specific, high-speed type of quantitative trader.
So why are everyday prediction markets betting their entire corporate strategy on this complex mechanism?
What's fascinating here is that the sheer scale of the money dictates their strategy. If we look at the data from CryptoQuant from just last month, March 2026,
Yeah.
the global trading volume for perpetuals hit $3.5 trillion.
Trillion with a T.
Trillion with a T. To put that in perspective, the spot market, which involves taking actual ownership of a digital asset, was only 0.8 trillion.
Wow. So perpetuals are currently like 4 times the size of the underlying market.
Exactly. And the spot market is actively shrinking. It contracted 48% in the first quarter of 2026 alone.
Because traders don't want the friction of owning assets, right? They just want leverage and capital efficiency.
Exactly. Major exchanges like Binance currently dominate the space with about a 40% market share. So if you are a platform trying to scale, perpetuals are the undeniable engine of global market liquidity.
Prediction markets simply want to capture a slice of that $3.5 trillion pie.
Right. But here's the thing. If Polymarket's entire strategy relies on the lawless speed of crypto, that leaves a massive trillion-dollar blind spot.
Institutional Wall Street money. Because they legally can't touch unregulated platforms.
Exactly. And that exact blind spot is what their main rival, Kalshi, is trying to monopolize.
Here's where it gets really interesting. You have Polymarket on one side and Kalshi on the other, executing vastly different strategies to capture that $3.5 trillion market.
Yeah, it's a massive turf war. Polymarket is currently valued at $9 billion, and in the first quarter of 2026, they consistently surpassed $1 billion in weekly volume.
Their architecture is just pure speed, right?
Yeah.
And deep integration into the crypto ecosystem. They run on blockchain networks like Ethereum and Polygon.
Yeah, and their primary medium of exchange is USDC.
For those unfamiliar, USDC is a stablecoin, a type of cryptocurrency specifically pegged to the value of the US dollar to avoid massive price swings.
Right. Polymarket's philosophy is fundamentally decentralized. They operate under the premise that code is law and anyone globally can participate 24/7.
They move incredibly fast.
Fast is an understatement today.
Seriously. Kalshi's CEO, Tariq Mansour, had a roadmap leak stating they were going to launch their highly anticipated perpetuals product called Timeless on April 27th in New York.
Right. And Polymarket saw that leak, mobilized their engineers, and pulled a massive surprise move.
They launched their own perpetuals today, April 21st, literally hours after the Kalshi rumors circulated. They totally ambushed the launch to steal the thunder.
It's a brutal move.
But let me push back on this for a second. In software, we always talk about the first mover advantage, but does rushing a product out the door actually matter in finance?
It does, but maybe not for the reasons you think.
Right, because if I launch my trading platform first just to beat my rival, but my system crashes under the load, or regulators shut me down tomorrow, who cares if I was technically first?
That's a fair point. But first mover advantage in this specific financial architecture isn't about PR or getting retail users to notice you first.
What's it about then?
It's about capturing the market makers. These are the massive institutional trading firms that stand ready to buy and sell instantly.
Ah, okay. The ones providing the billions of dollars in liquidity.
Exactly. They create what we call order book depth.
Meaning, if I want to place a huge bet, there needs to be enough money already waiting on the other side of the trade, otherwise my own bet will wildly distort the price.
Spot on. A deep order book means someone can drop a $10 million trade and the price of the asset barely twitches.
And a shallow order book.
A shallow order book means a $10,000 order could cause the price to crash 5% simply because there aren't enough buyers to absorb it.
Okay, I see. So if Polymarket launches first and manages to integrate those market makers, they create an impenetrable moat.
Precisely. A professional trader won't move to Kalshi if Kalshi's order book is shallow and their trades suffer from massive price slippage.
So the ambush launch today isn't just a PR stunt. It's a calculated strike to lock in the market makers before Kalshi can even open their doors.
Yep. But Kalshi is playing an entirely different game. They are valued slightly higher at $11 billion and handle over $100 billion in annualized volume.
And instead of utilizing decentralized blockchains and stablecoins, Kalshi is leaning heavily into aggressive regulatory compliance.
Right. They want to be the primary bridge for traditional finance TradFi. They require US dollars as collateral specifically so they can partner with established brokers.
Like Coinbase and Robinhood, right?
Yeah, exactly. Kalshi's strategy is to act as a VIP pass into the highly guarded plumbing of the traditional US financial system.
Because institutional Wall Street money simply cannot legally interact with platforms that don't have strict anti-money laundering protocols and federal oversight.
Exactly. By strictly using US dollars and adhering to federal compliance, Kalshi can onboard billions of dollars from traditional hedge funds that Polymarket physically cannot touch.
But that strategy of relying on regulatory compliance is currently putting them in the crosshairs of a massive legal brawl, isn't it?
Oh, absolutely. It's a huge mess.
Kalshi is banking on its federal license to win the long game. But right now, we are watching a full-blown turf war between individual U.S. states and the federal government.
Over who actually controls these platforms, and the state-level resistance is fierce. Several states, including Illinois, Connecticut, Arizona, and Nevada, have been issuing cease and desist letters directly to these platforms.
And the core issue there is classification, right?
Exactly. State regulators are looking at these perpetual contracts based on real-world events and classifying them fundamentally as illegal sports betting or unlicensed games of chance.
So they are attempting to block access entirely at their state borders.
Yes.
Normally, if a state tells a company they can't operate within their borders, that's just the end of the discussion.
Right, but not this time.
Yeah, the CFTC, the Commodity Futures Trading Commission, our federal derivatives regulator, actually stepped into the ring and filed lawsuits against these states.
To stop them from banning Kalshi and Polymarket.
Which is wild. Why is the federal government stepping in to protect what looks like a casino?
If we connect this to the bigger picture, the CFTC's intervention relies on a crucial piece of historical context. In 1992, the Futures Trading Practices Act was passed to unify the national market.
Okay, so the CFTC is arguing that these are not games of chance.
Exactly. They are arguing they are derivative contracts, meaning their value is legally derived from an underlying real-world event or asset.
And under that 1992 precedent, the CFTC claims exclusive federal jurisdiction over derivatives.
Right. Their argument is structural. If you allow Illinois to apply gambling laws and Nevada to apply sports betting laws, you basically shatter the national market into a fragmented patchwork.
And historically, a fragmented regulatory environment just creates dark pools where fraud thrives.
Exactly.
I understand the desire to avoid a fragmented market, but let's be real for a second. Put yourself in the shoes of a state regulator in Arizona.
Oh.
If I download an app and place a highly leveraged, never-ending financial bet on whether it's going to rain heavily in London next Tuesday, or whether a specific politician will drop out of a race, isn't that just pure speculation masquerading as high finance?
Well, to a retail user placing a $10 speculative bet on their phone, it certainly functions like gambling.
Right.
But the CFTC does not regulate platforms based on how a retail user feels, you know? They regulate based on utility for the broader economy. These markets are critical mechanisms for hedging risk.
Hedging risk, like how?
Consider a multinational agribusiness. If their entire profit margin depends on crop yields, a perpetual contract on weather patterns allows them to financially offset the risk of a drought.
Oh, I see. Or like a supply chain logistics company hedging against geopolitical instability affecting shipping lanes.
Exactly. The CFTC views these platforms as foundational architecture for corporate risk management.
So if a business can utilize these prediction markets as a form of highly liquid insurance to protect their operations, then they are vital financial instruments, not a casino game.
That's the federal argument, yeah.
So this upcoming court battle isn't just about whether an app gets banned in Nevada. It's going to definitively decide if these prediction markets become a federally protected staple of the national economy.
Or if they just die a slow death by 1,000 state-level paper cuts.
Which brings us to the most important question for you, the listener.
Okay.
So what does this all mean? We have billions of dollars moving rapidly, federal courts battling states, and now everyday users are stepping into this extremely complex arena.
It's dangerous.
I want to emphasize that this is an absolute minefield. Simply being good at predicting a political outcome or a pop culture event is no longer enough to win.
Right. Surviving this new market requires mastering these financial mechanics. The knowledge gap among retail users right now is the system's biggest vulnerability.
Because of things like the funding rate we discussed earlier.
Exactly. That recurring fee buyers and sellers pay each other to tether the contract to reality. If a novice trader transitions from the old era of simple expiration-based prediction markets and they enter a perpetual contract using 10x leverage,
Meaning they're putting up $100 to command a $1,000 position.
right, they might be totally correct about the underlying event, but if the market sentiment is heavily skewed in their direction, that invisible funding rate fee will compound rapidly.
It can literally drain their entire collateral balance in a matter of days while they just wait for the real-world event to actually occur.
It happens all the time.
And beyond the sheer math of the trades, there's the massive counterparty risk. You are trusting the infrastructure of the platform itself.
Yeah, we've seen black swan events in the decentralized finance space where entire protocols collapse overnight due to cascading liquidation.
The liquidation engine is ruthless, isn't it?
Oh, completely. When a highly leveraged trader's position drops below their required margin, the system doesn't send them a polite email asking for funds.
It just forcefully sells their collateral to cover the debt automatically.
Exactly. Imagine thousands of traders all holding highly leveraged positions. If the market dips sharply, the system triggers automatic sell-offs for the first group of traders.
Which instantly drops the price of the asset further, which then triggers the next group's automatic sell-offs.
Yeah, it creates a domino effect, a cascading liquidation that can wipe out millions of dollars of value in seconds.
And Polymarket and Kalshi are facing very different technical hurdles when trying to prevent those cascades.
Very different, yeah.
Polymarket relies entirely on blockchain architecture. So if the Ethereum network gets congested during a major news event, the gas fees, which is essentially the cost to process a transaction, will just spike.
The gas fee mechanic operates basically like surge pricing on an Uber. If market volatility spikes and everyone rushes to the exits at once, the surge pricing to process a trade on the blockchain can skyrocket to hundreds of dollars.
Oh, wow. So you might see your position losing money. You desperately want to close your trade to stop your losses, but you are physically trapped in the position because you cannot afford the astronomical transaction fee to exit.
Exactly. Polymarket's promise of a seamless 24/7 market is entirely dependent on the underlying blockchain not clogging up under pressure.
But Kalshi completely avoids that blockchain congestion problem because they operate on centralized servers.
Right, but that brings a completely different kind of pressure.
Yeah, they have to prove to these massive institutional Wall Street firms that they possess the unbreakable, rock-solid stability of a traditional exchange, like the Chicago Mercantile Exchange.
Right. If a massive geopolitical event occurs, and millions of users flood Kalshi to hedge their portfolios, and Kalshi's servers crash.
Their entire meticulously crafted reputation as the safe, federally regulated bridge to TradFi just instantly evaporates.
This raises an important question for anyone navigating this space right now. As these platforms introduce infinite duration and high leverage, are we prepared to separate genuine quantitative trading talent from pure speculative luck?
Because during a bull market where prices generally trend upwards, heavily leveraged bets can look like absolute genius.
Exactly. But when severe volatility hits, the traders who survive will not be the ones with the best political intuition.
They will be the ones who deeply understand how to calculate funding rates, who monitor real-time order book depth, and who comprehend the structural risks of the platforms they are utilizing.
It really is a completely new paradigm.
It is. We started this deep dive looking at the old world of simple prediction markets, locking in your money, and waiting patiently for an election night or a Fed report to see if your intuition paid off.
And in the span of just a few aggressive years, we've arrived at a multi-trillion-dollar derivatives turf war.
Polymarket and Kalshi aren't just letting you predict the future anymore. Through perpetual futures, they're letting you trade the present infinitely with borrowed money.
All while the states and the federal government battle over who legally gets to referee the match.
Yeah, it forces us to step back and look at the broader trajectory of our financial system.
If Polymarket and Kalshi succeed in their ultimate mission, they are going to develop the architecture to turn any measurable real-world event into an endless, highly leveraged perpetual future.
Which is kind of terrifying. What happens to society when every conceivable metric is financialized?
Could we see a near future where everyday occurrences like the weekend box office numbers of a new movie, or the daily construction delays of a local bridge, or even the hourly temperature in an agricultural hub are actively day traded by high-frequency Wall Street algorithms?
Are we effectively turning the fabric of reality itself into an endless 247 stock market?
It certainly looks that way.
And if the very fabric of reality becomes a 247 stock market, that agonizing weight we talked about at the beginning of the show The simple act of waiting for an event to naturally conclude before dissecting the outcome is gone forever.
It really makes you wonder.
But maybe, just maybe, some things are actually worth waiting for. That is all we have for today. Remember, we put this deep dive together just for you, to help you decipher the complex mechanics beneath the headlines, to prepare you for the risks, and to keep you a crucial step ahead of the curve.
Thanks for listening, and we'll catch you next time.